So rate cuts have begun, and you think there's more to come. And some might point to the loosening monetary policy as maybe one of the contributors to a rising stock market. It has been a great year for the stock market. And, when we ask our listeners what they want to ask you, one of the things they bring up is the Magnificent Seven, which have continued to dominate market performance. These are the largest companies in the S&P 500. Our listeners are wondering about that concentration and whether they should be concerned about it. When do you think we might start to see a broadening out of the equity market performance? In other words, starting to see the other 493 companies in the S&P starting to contribute more?
Absolutely. So we'll talk a little bit about this Mag 7 dominance, if you will. So just looking at the numbers for October itself, Mag 7 and technology stocks as such were up close to 5%. Meanwhile, a more equally weighted S&P 500 was actually down for the month. So again, reiterating that point that the largest companies that are focused in tech, maybe communication services, are really driving the returns. And that's what has been bringing about a lot of questions. But before we get too concerned about that concentration, if you will, is an acknowledgement that we all need to make around why that is happening. And that is happening because earnings growth is largely in those Mag 7 as well as broad technology names. So we're in the midst of earnings season right now. And what we're finding is actually that earnings season is strong. So even outside of Mag 7, the S&P 493 is actually at a very strong about 9% earnings growth right now as of what's been reported in Q3. But Mag 7 is close to about 24%. So for us to continue to think about that broadening out concept, a couple of things have to happen. Number one, we have to see, as we already have, we have to see the rest continuing to show earnings growth. And I think we've begun to see that, especially if we compare ourselves to this time last year, where actually the rest of the 493 were not generating positive earnings growth at all. So compared to that, 9% earnings growth for 493 is very, very solid. So we're beginning to see the earnings growth come through. But frankly, if the earnings growth and if the capital expenditures, CapEx as we call it, is coming from a majority point from these large hyperscalers, from these large cloud companies, it's really hard to imagine that we can see a broadening out into the small cap parts of the market. So we still think when and if the broadening comes, it'll still very much be within large cap. And we are heartened to see some of the earnings come through this year and in this quarter particularly that is favoring the 493, even though for right now, it is still tech, which is leading earnings growth and therefore leading performance.
One thing that comes to mind, we recently spoke to Alex Brazier, your colleague, and when we asked him whether AI and these Mag 7 companies are in a bubble, he actually said, well, it's more of a mirror, I think was the analogy that he used, that their stock prices are rising, but they're reflecting, hence his use of the term mirror, reflecting the earnings growth that I think you're alluding to. So stocks are rising, but their earnings are rising, and that's part of the reason why. The other thing you mentioned, I think, is that the gap in earnings growth between the Mag 7 and the rest of the market is narrowing.
It is narrowing. At the same time, it still exists. So both are true. There is still a gap, but the gap is a lot narrower than it used to be. And more importantly, that the growth for the 493 is at a very healthy 10%. Now, of course, the growth for technology stocks is at an even healthier 25%.
As that gap narrows, though, is when you could see the broadening out of the market. And you mentioned we're in earnings season right now, and these are important periods for the markets during the year where we get a read into the economy and what companies are seeing and how healthy they are. Talk a little bit more about what is your read on companies in terms of what they're telling us so far?
Yeah. And before we actually talk about this earnings season, I want to give you sort of view into what the expectations were, because markets are all about what is expected versus what we get. And coming into Q3 earnings season after a spectacular Q2 earnings season, the expectation coming in this season was about a 6% earnings growth. Now, this is like me saying I'm going to run a 5-hour marathon. I know that I can probably beat that. So when I run a 4.5, I'm actually kind of happy because my expectations had been lowered. So similarly, going back to the running analogy, maybe I extended it too far, but similarly, the expectations were quite low, so they were easier to beat. Now, as we're sitting today, as we're looking at the numbers come through, about 82% of the companies that have reported have beat their earnings expectation. Both sales as well as revenues are beating, and the beat is higher than they were in the previous few quarters. And then earnings growth is coming in for the entire S&P about 12 to 13%. And again, that is led by a few particular sectors that we talked about. It's certainly led by tech and communication services. There are also a couple of other things that we watch. We also parse through data, and obviously very easy to do that with some of the AI tools we have now at the firm, but really looking at what are some of the trends that are coming through. So obviously one big one is around that capital expenditure, the CapEx season, as we joke that it has become. How much of the hyperscalers, these large cloud companies, are doing CapEx. So that's been something that, again, has surprised to the upside from the large 5 or so hyperscalers. CapEx is greater than what was expected, even at the start of earnings season in the end of September. The second thing that we watched is to what extent was that CapEx that has been already done resulting in revenues. And again, one of the numbers a colleague shared was the 10 biggest spenders. They have $2.5 trillion in revenue, $600 billion in cash, and they have zero net debt. Now, those are some very powerful dynamics that are taking place. But away from hyperscalers and CapEx and tech, I also think that there are a couple of other things that we need to focus on. The first one is just the consumer trends. There's certainly premium shoppers that are spending on purchases like iPhones or travel. And then we're seeing value seekers that are looking as well to other parts of the market and perhaps some other names that aren't doing as well because of who is shopping there. So that's becoming quite evident in earnings season. And then the other one, GLP-1s are obviously a big theme of earnings season. And obviously some of those drug producers had some incredible quarters related to the continued adoption of GLP-1. So those are some other themes that we're looking through. And then maybe I'll leave you with one last one, which is just around tariffs. Obviously very top of mind for consumers as well as corporations. And it's been interesting to see that some of the tariffs are coming through, or some of the tariff concerns are coming through in certain parts of tech, semiconductors specifically.